Well, welcome to Monday, folks. Happy Monday to all, as Maud said earlier. Latest of my series of webinars at Epic Street about to begin. Special thanks to everyone at Epic Street for making this event possible and for inviting me back. Really do enjoy these events. As I've said many times before, I hope it's beneficial to at least a few of you who've attended these events in the past, and actually it's truly beneficial to me as well, because it gives me yet another reason to review today's trading and market activities. So let's get started. The purpose of this event is education. I'm not going to provide specific trade alerts or recommendations, but we will review the trading day that has just passed before our very eyes, at least for many of us, and we'll take a look ahead at and at least ponder what tomorrow might bring. Hey, Gam. Michael Ho making his regularly scheduled appearance. Michael, when was the last time you missed one of these webinars? And Michael, I'm not making fun of you. I'm really glad that you and many others make regular appearances here. It seems like it's been a while. You're pretty much a regular here. Well, I'm chuckling on myself right now because many of you could probably guess which pair I'm going to cover. Is it a real mystery here? Which pair am I going to talk about? Gee, I wouldn't know, especially considering I'm watching some video on CNBC right now. It's not distracting me much, but CNBC was just posted a little banner on their screen saying that Spanish yields above 6%. So I'm sure many of you are aware of that. If you're not, I will make you aware of it now. The yield on the 10-year Spanish government bond did rise above 6% during today's, rose above 6% during today's London session. That's the highest level seen on the Spanish 10-year government bond. Looks like it's about 6.1% right now. Highest level seen on the 10-year Spanish government bond since early August, when the ECB first came back with its so-called securities markets program. That's its bond buying program, which was originally launched in May of last year to help buy up Greek government bonds. Gugana says Euro Swissy. Actually, interesting guess, but no, I haven't been too keen on the Swiss franc pairs of late. Although there was an interesting setup to take a shot on the Euro Swissy, it just hasn't shown quite the volatility that it used to. You can see a Euro Swissy chart in the lower right-hand portion of this view. I've kind of got obscured because Swiss franc just kind of has done its own thing, and it's been a little too inert, a little too neutral for my taste of late. I mean, the Euro USD has moved much better, especially in the past few weeks. But it really, as I see it, ever since the S&P put a floor of about 1.20 on the Euro Swissy, ever since then the Swiss franc has it just behaved differently. The volatility hasn't been there, and it hasn't, especially hasn't shown the kind of correlation with either the other currency pairs or especially the other financial markets that it used to. I mean, as I've described in the past, the Swiss franc was, as I saw it, especially early this year, one of the first choices as a safe haven currency. It's almost like the order of safe haven currencies. First choice Swiss franc if there's any news out of Europe which would cause safe haven flows, which would cause a risk-off mood in financial markets. Then it was the yen, then it was the dollar. Well, now we're in a situation where the Swiss franc is neutral more than not. The yen has its moments, but by and large, the yen is kind of playing second fiddle to the dollar these days in terms of risk on or risk off. And as I see it, you can hardly tell on many days. You can hardly tell the euro yen apart from the euro USD. They both move so much in lockstep. They're almost one and the same trade. So yes, the euro USD that was the focus of our live coaching and our trading today at FX Bootcamp. So let's take a look at the euro charts. I've got a separate profile here dedicated to the euro. It's probably deserving a quick review. I haven't done this in a while, and I should do this real quick. This is a standard view used by not all, but a lot of the coaches at FX Bootcamp. I'm showing from left to right a 15-minute chart, an hourly chart with daily pivot points, most of which you can't see because of the scale of the chart. You can see now all of the, now you can see all of the pivot points, daily pivot points, S3 at the bottom, R3 at the top, and everything else in between. So hourly chart with daily pivot point, that's a common part of our standard profile of charts at FX Bootcamp. To the right of that is a 4-hour chart with weekly pivot points, which I'm now bringing into view. And on the right is a daily chart with indicators. So 15-minute chart, hourly chart, 4-hour chart, daily chart. 15-minute chart, you could argue, is our bread and butter chart at FX Bootcamp, although we have at least one currency coach that has a specific preference these days for a 1-minute chart, but it's to each his or her own. The 15-minute chart, by and large, if you had to pick what's our bread and butter, what's our standard chart for so-called spot trades you would enter and exit within the course of a single trading session, it's usually the 15-minute chart. That's the one we focus on the most. But everything when it comes to deciding whether you're a bull or a bear and your bias and even entries on a 15-minute chart, all those decisions, bias and levels of support and resistance, all that is derived from the other charts. The daily chart down to the 4-hour chart, down to the hourly chart. So anyway, I haven't done that overview in a bit. Let's go to which chart I want to show you here. Yeah, I like this hourly chart, although I need to trying to decide I want to stick with this or not. Yeah, I think I will. I actually want to drop some of the lines in this chart because it will take away from one of the main points I want to make. Yeah, let me go to a 4-hour chart first. Yeah, this is the view I want to show first because this is a trend line. Actually, you see an orange. Let me make the trend line thicker on my 4-hour chart here. It's an orange trend line. I'm going to make it really thick, not because it's super duper 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 important, although I guess by some arguments you could say it is. But I've only made it thicker just to make it stand out so you can see what I'm talking about here. I've got a trend line, an orange trend line on this 4-hour chart going back to the early October low for this pair. So you can see the early October low in the lower left-hand corner of this 4-hour chart. You can also see my cursors next to it, some more recent higher lows. Those higher lows started around the first of this month, 1st of November. November 1st low, November 7th low are going to be also the basis for that orange trend line. And we actually ended Friday testing that trend line, piercing it maybe a bit by different measures, but never really breaking past that trend line. Today's early Asian session trading, essentially the Asian Open, well, not really Asian Open, but it's the Asian Open is different from when the time markets open. I guess you can call it the Kiwi Open, the New Zealand Open today. when markets first opened for trading on Monday. The open today just above, but in the vicinity of that trend line. Just above, but very close to the orange trend line in the 1.38 area. And since then, it's been down all day. So I wanted to bring that trend line to your attention because that could have been at least part of the reasoning behind the market, especially in the early Asian session trading, being down today. More of a technical factor. But let me, I'm going to make this trend line thing, and I don't want to delete it entirely, but I'll make a thing on it again because I want to reference some price action from late last week. I want to go back to an hourly chart. Now here, and this is something I'm going to discuss. I haven't recorded it yet, but I'm going to record this after this webinar here. I'm going to record a New York session video review, and I'm going to talk about some of the things on that review that I'm going to talk about right here. So actually, if you don't understand or you don't catch or whatever some of the things I'm talking about here soon, I'm going to reiterate these things in a New York session video review that we'll post on FX Bootcamp's on our YouTube page. I will also post this on the Forex Street blog. So anyway, here's one of the things that struck me about price action in recent days. Many of you are familiar with the sell-off or aware of the sell-off we saw last Wednesday. There's last Wednesday's sell-off. Of course, that was sparked, as I see it, at least sparked in the part, by the move by LCH ClearNet, the clearinghouse in London, to raise its margin requirements on Italian bonds across the board. That seemed to trigger not only did it trigger a sell-off in Italian government bonds, we saw the Italian 10-year yield spike above 7%, but also that sparked a sell-off in the euro. So euro sell-off during the course of not only last Wednesday, but even the early part of Actually most of Thursday's Asian session. So you see the euro session result. And we spent the greater part of Thursday, starting with London Open, trying to for the euro trying to claw its way back up. And during Friday's New York morning session, which I haven't had the chance to discuss with all of you here yet, those of you who attend my regular webinars, the euro broke above that 3660 area, which has been so important. 3660 levels represented by the horizontal green line in the middle of this chart. And I don't think I guess I will anyway. I'm showing a 4-hour chart again for the euro here, and I've highlighted at least a couple of lows achieved in October with the red arrows there. You can see we've spent some time. We've spent several weeks now. I can zoom out further to give you a look at that. We've spent several weeks with the euro flipping either from up to down or from down to up around that 3660 area. So nothing new there. That area has been important to the euro in the past. And what happened Friday was, call it, triggering of stops, short squeeze, end of week profit taking. That was part of it. We had some events unfold on Friday, which, although not really surprising, were if anything euro positive. I'm talking about the Italian Senate vote to approve the austerity package making its way through Italian Parliament. That was revealed, I believe, around 6 a.m. or so New York time on Friday. We had the Greek Prime Minister. The new Greek Prime Minister was named. What else? The U.S. University of Michigan consumer sentiment number was notably better than expected. Now, although U.S. news hasn't moved the market that much, that didn't hurt. That U.S. news did not hurt the case for a risk-on scenario on Friday morning or during Friday's New York morning session. But I would argue beyond that, we had a bit of a short squeeze there on Friday with the euro rising up to near 138 before the end of the trading day, actually, and the end of the trading week. But what's notable about that Friday move was one thing that was notable to me anyway. We never did fully retrace the sell-off from last Wednesday. I mean, it was close. We never quite fully sold off. I'm sorry, we never quite fully retraced. There was not a 100% retracement of last Wednesday's big drop, which I'm showing near the middle of this hourly chart. And here's another perspective that I was pondering during my coaching session today. Not only did we not completely retrace that drop from Wednesday, but if you look at just the move during the New York morning session, then the move above 3660, again, the horizontal green line here, we fully gave up those gains on the euro during today's Asian and London, mostly London sessions. So the big drop from last Wednesday, not fully retraced, there wasn't a full reversal of that drop, although fairly close, not a full reversal of that drop. And we did reverse, if you will, the move above the 3660 level, which again materialized during Friday's New York morning session. So those were the technicals, and actually there was more technical factor I want to cite for some of you. There was I'm going to switch this to a 4-hour chart. Note where this is the 4-hour chart. Notice where stochastic started the day and week. 4-hour stochastic started the day and week overbought. You see my cursor highlighting that in the lower right-hand portion of the view. Overbought. That, if anything, is euro bear friendly. So overbought 4-hour Stokes, arguably, as I discussed earlier, a trend line retest, a trend line going back to early October. And those were just technicals as I saw it. Now, in terms of news flow or so-called fundings, call it what you want, I saw a lot going on today. Yeah, so try and trader. I mean, you have a valid point there about the longer-term downtrend. But try and trade. I want to warn you that and many of you who are here already know this. The euro has been fickle of late. Fickle in terms of when you swear. I mean, actually, last Friday was an example where you think you have a great case for shorting the euro, and then we get price action like we saw at last Friday's New York morning session, where attempts to short were just, were all for naught, especially after the break above 3660. It was a one-way street up for the euro during that Friday New York morning session. And when the euro's been like that on several days over the past several weeks, where you think it should drop more than it does, and some days we do get big drops, but other days it's like up one session, down the next, up one session, down the next, down one session, up the next. We've gotten a lot of that lately. I've heard some commentators, some fund managers on TV talk about this, how frustrating the euro short trade has been, and use those shorting the euro as a position type trade, a trade they would hold for weeks or months. It's been a challenging trade because it hasn't been a one-way street all the time. The euro has dropped in fits and starts, but it's been spent days at a time where it's been like flippy-floppy, up one session, down the next, as I described earlier. Oh, but yeah, in terms of news flow today, a few things caught my attention over the weekend and early from today's news flow through the Asian and London sessions. First of all, did anyone notice an article published in London's Telegraph? I believe it was published yesterday. It might have been Saturday, but I thought it was yesterday. Article in London's Telegraph talking about last week's EFSF bond auction. The EFSF, that's the European Financial Stability Facility. That's the rescue fund established for the Eurozone in about May of last year. Well, this EFSF has been trying to sell bonds to fund itself, trying to sell bonds. And it was, I've talked about this in webinars past here at FX Street. The EFSF had tried originally about a couple weeks ago to conduct like a 5 billion euro bond auction. Well, it postponed that bond auction, especially as Italian yields were spiking. The FSF decided, poor market conditions and decided to postpone the auction. Well, they had the auction last week. The auction was not a 5 billion euro auction. Instead, it was a 3 billion euro auction. So they scaled down the size of the auction. I believe they actually reduced the coupon level as well, the maturity level. It was an auction of, if I'm mistaken, shorter term. I forget what denomination they were selling, but it was a shorter maturity level than was originally intended. But anyway, here's what the London Telegraph talked about in an article over the weekend. I believe it was yesterday. That the EFSF itself, the rescue fund itself, had to buy some of that paper, had to buy some of its own paper. In other words, the bond auction itself from the EFSF was not fully subscribed. And Moneyman is talking about now, and no one wants to buy those bonds. Come on, Moneyman, can't you step up a little bit? Don't you want to buy some of those bonds? Come on, I bet Moneyman is eager to buy some of those bonds. But yeah, it's a valid point. It's something that I've heard from several officials. Merkel, for example, when Merkel attended the G20 meeting in the first week of this month, she actually stated that several leaders, several countries represented at the G20 meeting in Cannes, France. Several leaders had told her that I don't think she said it in these terms, but the message that she said in a statement, the implied message, sorry to hit the mic there, the implied message was that Merkel didn't sense a whole lot of interest amongst G20 leaders in buying EFSF bonds. So Merkel, I sense there's some disappointment there in the level of interest, or should I say lack thereof, in acquiring EFSF bonds to help something to help support Europe. And then we get this bond auction last week, which apparently was undersubscribed, was not fully subscribed. So you got that going on. And then what I noticed during today's Asian and London sessions, well, first of all, there was an article in today's Financial Times, which I discussed during my live coaching session, an article involving an interview with the Bundesbank president, Weidmann, W-I-E-D, or is it W-E-I? Let me check here. I've got this article. It's like page 3 or page 5 or something like that. W-E-I-D, W-E-I-D-M-A-N-N, Weidmann, the Germany's top banker. It wasn't so much what Weidmann said in that article in the Financial Times, but what he didn't say. Historically, the Bundesbank in Germany has been opposed to the ECB's, that's the European Central Bank. The Bundesbank has been opposed to the ECB's main interest rate going below 1%. Well, what's notable in that article was what it didn't mention. Weidmann apparently didn't re-express those kinds of concerns. Weidman didn't say anything along the lines of, I hope the ECB doesn't lower rates below 1%. So it sort of left the door open for the ECB to do more. Plus, Jürgen Stark, the outgoing, well, he's still there for now, but he will soon be leaving, a key member of the European Central Bank Governing Council, who announced his resignation from the ECB, late August, early September, something like that. Stark said there's something to the effect of there's room for the ECB to cut rates more. So a couple of so-called dovish comments from officials in Germany. I say German because again, Stark is German, and of course, so does the Bundesbank president. So a couple of so-called dovish comments, seemingly paving the way for more rate cuts from the ECB. The question is, how much, how quickly they will come. We'll find out, maybe find out some of those clues early next month at the ECB's next meeting. So you had that, and then I mentioned earlier in this webinar the yields on Spain's 10-year government bonds. Those yields surpassed 6% in today's London session. I believe the spread or difference between the Belgium's 10-year government bond and Germany's 10-year government bond reached a new post-EMU record. So to sum all that up, an unsubscribed or not fully subscribed EFSF bond auction last week, according to the information published by the London Telegraph. You have some relatively dovish comments from the likes of Stark and Weidman. You've got bond yields rising in the southern periphery of Europe. Today, the focus seems to be Spain. And actually, as of the open of the New York morning session, roughly 8 a.m. New York time, as I recall, the 10-year Italian bond yield was in the upper half of the trading range for the day, back above something like 6.6%. So, given all that, put all that together, you certainly have reasons to look to sell the euro today. Yeah, money magnet. Money magnet to some degree. To some degree, we found that out last week, don't you think? That sell-off we got on Wednesday was should have been truly due in part to the spike in Italian bond yields, which in turn, I would guess, is due in part to the ECB stepping back its bond buying. Now, we'll never fully know what Italian yields would be without the ECB buying bonds, but here's my point. We saw it was something north of 9 billion euros worth of bonds bought by the ECB, not last week, but the week before. Last week's bond buying, a little over 4 billion euros worth. So my point is this. It seems, and there's been talk about this, and it seems like the latest numbers from the ECB confirms it. There was talk about the ECB stepping back and minimizing or maybe even stopping for a couple of days or so its buying of Italian bonds last week as a means of putting pressure on in the Italian government, specifically Berlusconi, to essentially force them out. And, I'll leave it to all of you to decide if that was the real intent. And if it was, then, if that was the intent, then it seems to have succeeded. So anyway, that was the focal point for today in our live coaching sessions at FX Bootcamp was primarily, as I conducted my live coaching session, I spent time doing mainly two things. Number one, talking about opportunities to short. Number two, citing potential opportunities of long, but expressing caution about those opportunities because of all the different news flow which seem to support the euro bear case, plus the technicals I already discussed earlier. So let me take you to a chart that the kind of chart that I talked about in my live coaching session today. And is this showing the time I want to show it? Let me see here. Yeah, this is how a 5-minute chart looked at 8 a.m. New York time. And the reason why I showed this 5-minute chart, I'm hoping from this chart you can glean see the channel that I talked about in my live coaching session today. Let me use some arrows to highlight some swing highs on this chart. So you've got those highs, obviously a series of lower highs, especially defined or highlighted by the highs that I've denoted by the red arrows. And I've got some upward pointing arrows to highlight a series of lower lows. So simply put, let me make this make these trend lines blue. Simply put, you could have done something like this. And there you have it, downward channel. So the strategy for short, oh, by the way, I've got another line on this chart. I want to give it a different color to make it stand out. I've got a horizontal line at 3680, and I'm going to pick crimson for the color of that line. Call it red. You see the roll reversal at 3680 earlier. I'm going to mention that the reason why that's important in a moment. It's going to be the part of the basis for risk management on the short trade. So we had the euro flip earlier today during London session. At first it bounced at 3680, then it broke below 3680, it retested 3680, and then down from there. So first and foremost, what we discussed was the idea of shorting the euro at the top of the channel. And before the stroke of 9 a.m. New York time today, that chance came together. In this case, it was a short just below 3670, which I'm highlighting with my moving cursor on the lower right-hand portion of this chart. So a short at or near 3670. Oh, and the reason why I mentioned 3680, that could be a simple exit strategy. If you want to minimize your risk, you get out if the euro rises say a few pips above 3680. And folks, that was really the trade during the early part of today's New York morning session. Short around 3670-ish. And from there it was hold on to it. Let it run. Oh, the green line on this chart, that was a daily S1 pivot point. We got a bounce there, and this was just before today's New York session open. Daily S1. Yeah, there are times when S1 is support in one session and then resistance in the next session. I don't know if that's going to be the case here. I know the euro's rising of late. I admit this time of day, especially given the price action over the course of much of today's New York morning session, it was a bit choppy, a bit lacking direction. We got that final surge just near the end of the European trading day. The final surge briefly below 1.36. Other than that, it's been kind of just rather choppy, directionless price action very much for today's New York morning session. So my point is this: the short trade earlier, around 3670, it's one where, viably you just held on to it. And if you were targeting 1.36, we finally got there. We finally reached that psychological level of 1.36 just after London close, or just after noon New York time. A few minutes after noon New York time, we reached 1.36. That could have been a viable profit target. And like I said before, just about so many other pairs moved in sync with the euro. I felt like I was going to mention something else and just skip me what that was. Yeah, Ralph mentions Germany will oppose money printing. They've been pretty adamant about that. Yeah, the Germans have been adamant about opposing money printing. I gotta wonder if the so-called bond vigilantes are going to test the ECB's and really Germany's resolve on that. You've got a guy in there talking about Mario Draghi, who may be a little more flexible than his predecessor was. But bottom line, ultimately, it's going to be you would think up to Germany to some extent to allow for whatever the ECB is able or not to do. Or is the ECB truly going to flex its independent muscle? I think could be an interesting story to watch over the coming weeks. Sorry for the pause. Took a drink of green tea, which I've been waiting to do for like 30 minutes. Finally have my green tea, so now I'm all good. So look ahead. Well, folks, what can I say? That with the recent today's rise in Spanish bond yields, it almost seems like Spain has returned back to the radar for the global financial markets. Is watch those Spanish bond yields. Watch us. I mean, I'd say France as well. French bond yields, if they continue to climb higher. Here's what what's striking is this: either if the EFSF can't is unsuccessful in selling bonds, then you're going to wonder, what else can Europe do to help beef up or somehow lever that rescue fund, and if they do something different, then how could that affect France's sovereign rating? If you're wondering why French bond yields are spiking, that could be at least a big part of the reason. Bond markets, bond investors may be concerned about the implications of France supporting this rescue fund. So needless to say, I mean, the story with Europe is not over, and until the market finds something else to focus on, I'm still retaining that approach of watch Europe, specifically the bond yields in the southern periphery. Not arguably, even the core. I mean, even watch France here. France is considered one of the so-called core countries of Europe, and their yields are going more up than down of late, so it's worth keeping an eye on them. And I don't know if it's going to happen. I don't think it's going to happen tomorrow or this week, but I wouldn't be surprised if at some point over the coming weeks we start to see rumors resurface again about a cut to France's sovereign debt rating. Would not surprise me if that. Maybe the actual rating cut, if it's going to come, won't come until like even March or January, especially February. But over time, we could see the market become suspicious about the possibility and see the price that outcome in before it ever happens. Yeah, Erwin makes a good point about other auctions. Yeah, the argument, it seemed like the more important auction was the Italy, which happened today. And did I mention the Italian auction? I believe I did, and if I didn't, I apologize. But yeah, Italy sold some 5-year paper at highest yield on 5-year paper sold by Italy since 1997. So that was another part of the factor behind the bearish outlook for the euro today. Might be worth watching that Spanish bond auction, especially. I'm not so concerned about the Greek or Portuguese auctions. Those countries are already heavily into bailout territory in terms of the yields. But Spain, Spain is not there yet. No, that's if in terms of bond auctions in Europe throughout the rest of the week, that could be one worth watching. How effective or not can Spain sell government paper? And I'm checking in a news calendar. Seems a rather light, well, not crazy light week on the news side, but somewhat light. We have some inflation numbers coming out of the UK during tomorrow's London session. That's been known to move the pound in the past, although that story about inflation numbers in the UK moving the British pound, I don't sense that's been the case of late. Pound's been it's had its moments, but for the most part, pound's been fairly neutral. Not as neutral as, say, like a Swiss franc, but I haven't noticed some folks. If you've seen differently, I'm open to recognizing that or seeing this because I have been very euro focused of late. I admit this, but when it comes to, I have watched for the release of various reports out of the UK, standard economic reports, which historically have moved the British pound. I've just not seen the pound moving as much in response to support in those reports in recent weeks as I have historically in the past. So I'm kind of in a show me state, in a show me move when it comes to not just U.S. news reports moving the dollar, but even when it comes to standard reports out of the UK moving the British pound. But we've got one tomorrow. That's CPI, UK CPI due out during tomorrow's London session. Maybe a Bank of England inflation letter, but if there's going to be any news out of the UK, which any standard reports out of the UK which move the British pound, it might be the Bank of England's inflation report due out during Wednesday's London session. So you British pound traders, watch out for that. The next Bank of Japan policy decision coming up during the early part of, actually maybe the middle part of Wednesday's Asian session. Don't we have retail sales, U.S. retail sales coming up tomorrow? Could be interesting to watch. Could have some bearing on the market. Although again, I'm still looking for more proof that U.S. news will pack a punch in the currency market. GAM, I see what you're talking about. Oh, let me get back to my view of multiple charts here. GAM mentions seeing something in passing about UK having safe haven status. Now, in terms of the country's bonds, yes, wasn't it just last week that 10-year yields in the UK reached either new all-time lows or like multi-decade lows? So yeah, the yields that have remained suppressed out of concern for, among other things, Europe. The yields that have remained low, that have been dropping and continue dropping, have been those for Germany, for the U.S., and for the UK. And to be quite honest with you, that's really about it. That's all. Really, all that's on my mind right now. And that's the Euro short trade I mentioned earlier was one of the highlights. One thing I keep an eye on, and it seems way too soon for another intervention trade, but I'm looking at the a dollar yen chart, and you can see the dollar yen has given up about 2/3 of its post-intervention move late last month. And by the way, that was one hefty intervention. I forget the exact number, but that was one of the biggest, if not the biggest, unilateral intervention by Japan ever. I mean, they threw a lot of yen at the market. They threw a lot of yen at the market, and already the dollar yen has given up some 2/3 of those gains. Yeah, Cam, I see your last comment about the chancellor. So maybe this dollar yen may be something to watch over time. It seems too soon for Japan to intervene again. I mean, you got to think at some point they're going to all they're doing is just how do I want to say this? They're using mine, kind of, I guess maybe it's an American analogy, but it seems like to me they're applying speed bumps to the market. I've got to think that they don't expect to fully stop recent yen appreciation, especially given the concerns about Europe these days. But at least they're putting temporary speed bumps in place to slow down the Japanese yen's appreciation against the dollar. Now, maybe I'm wrong about that. Maybe they have this blind faith that if they keep doing it. Anybody remember the definition of insanity? Insanity is one definition of insanity: doing the same thing over and over again, expecting different results. Some would argue that's what Japan's been going through over the past more than a year with its interventions, which started in mid-September of last year. But as the dollar yen spends more time dropping than rising, and makes new, especially if in the coming weeks it makes fresh new all-time lows, the dollar yen that is, watch out for commentary out of Japan, specifically the Ministry of Finance. We may get some fresh new clues to another round of intervention coming. I don't expect them to do anything too soon, but because it'll if there's one thing a central bank doesn't want to look like, it doesn't look too desperate. It doesn't look too desperate. But then again, you can look with that. Well, some of you may think, well, what about what the Swiss National Bank did earlier back in August or September here? Well, the Swiss National Bank, I guess you can argue to some degree, was desperate. What they did do, which was seen to be effective and at least the right approach for now, is Swiss National Bank has essentially gone all in. Swiss National Bank has committed to do everything in its power, throw everything they can at the market to prevent appreciation of the Swiss franc. Now, that's something Japan has not yet done. Japan has not gone all in and say, we will do whatever it takes to prevent appreciation of the Swiss franc. They have not gone to that extreme yet. Maybe they will. I don't know. But you know what? I'll believe it when I see it. I'll believe it when I see it. Anyway, that summarizes my commentary on dollar yen. Gam, you may be right about the market tendency testing its will if Japan does that. Gam, I'll tell you this. I'm actually a bit surprised that the market, the currency market, hasn't tested the will of the Swiss franc, of the Swiss National Bank. Look at the Euro Swissy chart, a daily chart for the Euro Swissy. The horizontal blue line in the upper middle of this chart is the so-called line in the sand for the Swiss National Bank at 1.20. And I'd like to think that the Swiss National Bank is at least accomplished at a minimum what they hope. Now, certainly the Swiss National Bank wants the Euro Swissy to rise more, and it hasn't managed to do that yet. But what the Swiss National Bank has, if their minimal objective was to calm the market, was to stabilize the Swiss franc against the euro, so far so good. They've managed to do at least that much. But which is something we haven't yet seen for the Japanese yen against the dollar. Erwin asked about anything new about China back in the EFSF. Nothing new. Erwin, maybe you didn't hear me discuss this, but last I had heard, and I discussed this I think sometime last week, maybe it was even sooner than that, I don't sense China is, and one of you mentioned this earlier, and any comments during this webinar, I don't sense China, or maybe it was comments from a boot camp or in our live class at Ethics Boot Camp. I don't sense China is overly eager to do any more than they absolutely have to do to help Europe. I mean, China's view towards Europe is, well, number one, you got to wonder if if they look at what Japan pitched in terms of early purchases of EFSF bonds and Japan's nursing losses on those bonds. Number one, number two, seems like China is taking the same view as a lot of other of the emerging economies are, and that Europe's got to fix Europe's problems. That's the sense I get from recent comments from Chinese officials, that Europe has to fix what's wrong with Europe. Now, I would add this, I should say, if China may throw in more, may provide more fiscal support, may buy more EFSF bonds or provide support in other ways, if there's some benefit to China for doing that. In other words, is there something in it for China? Is Europe willing to give concessions to China for doing so? One of the things China would like to seek, I think, is a market economy status, which they don't have yet in the eyes of the World Trade Organization. Maybe that and plus other things might be some incentives for China to do more, but it's not something I've heard from that Europe's willing to offer yet. I'm reviewing some other questions and comments, see if I missed anything. Yeah, Gam, I'm sorry, Erwin. So what can I say? I mean, the last EFSF bond auction was not fully subscribed, and if you're debating whether or not China's interested in supporting the EFSF, I mean, there's an obvious answer. I mean, the market is the answer. And I mean, think about it. These bonds are. At least, I mean, at first glance, I mean, they're supposedly backed by the stronger core of Europe, and yet there's no demand for it. So, what does that tell you? It tells you something. It tells you something about not just China, but what a lot of countries think about throwing money towards Europe right now. Yeah, Ralph, and you know what? Ralph, that's a symptom of what's called by many economists, and actually not just economists but others, protectionism. protectionism, and that's a reversal, or it's starting to be a reversal of the kinds of moves that were made when things were going much better back in the 80s, especially in the 90s and earlier last decade. If you start getting more trade protectionism and stuff, that's not very good. That's not a good sign. Not a good sign. And with that should about wraps up my webinar for today. I want to thank all of you for participating, all of you for attending, even if you didn't participate. Special thanks, as always, to FX Street for making this event possible. And we'll do this again in about a little more than 23 hours. I'll give you a 23-hour break from hearing my babbling about charts and fundies and news and such. But if you're willing to return and listen to me again, I'll be here again. Same time tomorrow, same place. Thanks, everyone. Have a great day. Time for me to finish my green tea. Cheers.